You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics, and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
I'm very pleased to have joining me today Todd Salamone from Schaeffer's Investment Research. Todd is a Senior Vice President there who has a very long history in the business. Todd, I'm really happy that you were able to take time out of your schedule to speak with us today. Can we start with a little about your background in the industry, what your experience looks like, and what kind of things you're doing over there at Schaeffer's?
Sure. I joined Schaeffer's Investment Research in Cincinnati, Ohio, back in 1993. So, yes, I've got extensive history, 26 years in counting. And here at Schaeffer's, I oversee the trading area and the quantitative analysis area. And what we do as traders, we're not really managing money, but what we do is we have individual retail subscribers who pay a subscription fee to get both our bulletins and or alerts. Bulletins come out on a set date. Alerts come out anytime during the trading day, and they're real-time option recommendations. We're doing a lot of option buying. You buy a call, buy a put in a speculative format, but we also do other strategies such as straddles, credit spreads, iron condors, put sales.
That's a great description there, Todd. I know I've seen you give educational presentations around the country. You certainly know your stuff. And again, thanks for being here. I want to talk option strategy specifically from the long side. I know I've seen you give those types of educational presentations before, the long option side. So I do want to get there. But first, we know step one before you get to the trade is you have to have some type of market outlook or an opinion on market direction. Can you just give us a little bit of a description there, a few tools or studies that you use or that Schaeffer's might use to determine what that market bias might be?
Sure. And our tools are just that. They're tools. And we don't try to make things too complicated. We're looking at charts and we're looking at traditional indicators, looking at levels, but sometimes it's the simplistic that can really help you. For example, we've noticed the S&P 500 tends to respect round number year-to-date percentage levels. Lately, for example, it's been hesitating at that round 20% year-to-date. Not only has the S&P been doing that, but the GLD, the TLT, which are benchmarks for gold and bonds, doing the same thing, 20% year-to-date. And with the S&P, it coincides with a big round psychological level, 3,000. So again, just simple technical tools, but also, we look at indicators. We're contrarians, and we're ones that believe when everybody gets optimistic, that makes the market vulnerable, and when everyone's pessimistic, that's when it tends to put on the bottom. And we buy data from several exchanges that give us a clue as to what option speculators are doing. We buy what's called buy-to-open volume data on individual equities, and we aggregate it all, and we come up with that equity-only buy-to-open put-call volume ratio. And in fact, just a couple weeks ago, I was describing how we're entering this vulnerable phase, and we were entering that vulnerable phase because that buy-to-open equity put-call volume ratio was low, which means there was a lot of call buying relative to put buying on individual equities, and that was right when the S&P was bumping up against that round number resistance area, whether it was 20% year-to-date or 3,000. So, again, it's not perfect. It's simple, and we're using some sentiment analysis, and we're combining that with traditional technical analysis. But it tends to be technical analysis that really a lot of people aren't putting a lot into that we have found is meaningful.
Well, sure, that's a great description. Certainly keeping it simple is never a bad idea, but I appreciate how you got specific there and identified a few studies that you do look at. Shifting now into the option side of it, from the long options perspective, I'll get to a specific strategy here soon, but when you're long options versus selling them, there are certain general risks associated with being an option buyer or an option holder. So can you just talk for a minute about the general upside or downside risks associated with holding or obtaining long options positions?
Sure. When you're buying options, you're buying time premium, which in the time premium in a nonlinear rate decays over the life of the option. So that's strike one against the option buyer. And as an option buyer, you have to be correct whether if you're buying a call, you're betting on the upside in the stock or underlying, and if you buy a put, you're betting on the downside. And there's an expiration date with each option, unlike a stock where you've got as long as you want to eventually be right. When you're buying an option, you've got that expiration date, so you have to not only are you fighting that time premium, and the longer the expiration, the more time premium you're paying, which is and it decays, but you've got to be right in a specific time period. So yes, there are some factors working against you, but if you're willing to accept those factors, there has to be a reward, and that gets to the upside, and the reward is the leverage. You can make not only more than what you put into the trade, which is attractive, but you get that leverage. So, for example, if the underlying's up 10%, depending on the type of option you buy, you can have leverage of anywhere from 5, 10, 15 times. So if it's 10 times, the underlying goes up 10% over a specified time period, you might achieve a 100% return or more. So you have to, if you're taking on these risks, you have to be rewarded, and the reward is the leverage and those high percentage returns that options give you.
Well, that's an excellent description of both sides, and you're right. I always like to point out shares don't expire. Options do, so you have that difference to consider when you're long options. You have time working against you, and you have to consider that for sure. As we move a little bit closer to getting
one thing I say in my educational seminars is even the best fund managers in the world who are trading stocks have maybe a 50% win rate. And as an option buyer, you have to accept the fact that you're going to have something lower, and you're going to be lower than 50%, again, due to that time premium and the time decay aspect and that finite date by which you got to be right. So once you get to the point you can accept the fact that you're going to have a low win rate, that will force you to take that. I know, and I think we're going to get to that. That will get you into how you manage a position, which is a critical too.
Yeah, for sure. You're absolutely right. It's not easy to buy options and make money. That win rate might not be in your favor. You just have to manage the downside risk appropriately. We'll talk about that and capitalize on the trades when they do move in your favor. And you had mentioned a few strategies earlier at the beginning, and I want to start to move in that direction now. Once you have some sort of level of confidence on market direction, there's different ways you can implement options into the portfolio to be consistent with that. Now, how do you fine-tune the actual trade itself and select the right strategy? What type of factors are you considering there?
Yes, and again, Ed, what we do at Schaeffer's Investment Research is we look. We're using technical analysis, and we're using a lot of sentiment analysis, and we have quantitative analysts here where the traders here that are giving recommendations work closely with them, and we have multiple screens that are pushed out to us each and every morning. Some screens I don't look at because the trader next to me is looking at it, and that's his go-to screen, for example. But we're using technicals, and what we're looking at is sentiment that is contrary to price action. So let's say, just for example, keeping it, and we also use some off-the-radar simple tools. A lot of people may focus on a 50-day moving average. Well, some of our screens that we use this quantified data, we've seen just through observation, a lot of stocks will break their 50-day, but then the 80-day moving average holds. So we might have a screen that shows all stocks that have been trading above their 80-day moving average for the past 3 months. They've pulled back to within one standard deviation of that moving average. And historically, over a 5 or 10 year period, that has been a good time to enter the stock. Well, then we're assessing the quantified data there, and then we're also looking at, okay, so this might be a stock that's in an uptrend. What's the short interest like? What are option speculators doing? And if we see evidence that maybe the shorts are betting against it and they are losing money, or we see option buyers buying puts against this stock, we know that at some point there's got to be covering, and we know there might be a sense of urgency for that covering to occur since they're losing money. So again, or we might look at the analyst buy-sell ratings. Here's a stock that's in an uptrend. It's pulling back. The quantified data suggests this is a good buying opportunity. And, hey, look, there's if we give this thing time and buy 3 or 4 months, based on the analyst buy-sell hold ratings, the fact that there's a lot of hold ratings relative to buy ratings, that might suggest that there's potential upgrade potential in this stock that the options market is not factoring in. So, again, we're using that, and we've got other screens too. We're not only looking at we're looking at the implied volatilities of the options. What stocks are in the lower 10 percentile of their 52-week range? Looking at implied volatilities. That gives us an idea if the options are cheap or expensive. As an option buyer, I want to buy cheap options because cheap options, there's less time premium, less time decay. So I want to I've got to have some type of edge. So we have a lot of quantified tools that vary from trader to trader, but we're also always incorporating that sentiment concept into the opportunities that we identify.
That's a lot of great detail. I especially like the description you outlined there with the percentile of implied volatility. You get a sense of what you're paying for. A lot of investors, especially when they're new, don't pay much attention to that, and they just think market direction. I'm going to buy calls or buy puts, and they don't really focus on that. Implied volatility certainly has a big effect on potential profitability.
You're exactly right, Ed.
Yeah, and then let's move a little closer now. So now that we've got a lot of that set up, if you don't mind, could you pick a particular strategy? It can be as simple as you want, and just sort of outline how it would look. What might the steps you might take to initiate that position, open it, what the risk profile looks like, and the kind of things you watch and monitor while that trade is open. Can you just walk us through an example of that?
Yes. So like I said before, we've got many screens that we're looking at each and every day, and things. Now, not every stock that appears on a screen is necessarily for us answers the question why now in terms of a trading opportunity. So, depending on the technical setup, once we identify that situation, we are looking at things like implied volatility. So that's if we're looking to buy an option. Is the implied volatility cheap relative, again, to its 52-week range or relative to the historical volatility of the stock? So once we have some things in place from the technical perspective, the contrarian perspective in terms of whether, if we think there's upside, do we think there's an unwinding of sentiment that we can identify that's going to happen? And then we have to decide the time frame. That's a huge factor. Unfortunately, when you're buying options, and I say this in these conferences where I speak, there are so many options available. What strike do I choose? What expiration do I choose? And that's based on the indicator. If you see a lot of put open interest on a stock, which are downside bets, and again, we're buying data from exchanges, we know whether that open interest is bought to open or sold to open. If it's bought to open, we know the market makers are likely short the stock as a hedge. And if we know that put open interest is about to expire in the next week, well, we know the market makers are going to begin unwinding their position. So that might cause us to buy a shorter term option as we speculate on an up move in the stock. And, the strike selection, again, we usually do at the money or slightly in the money options. We tend not to do a lot of out of the money, because we have a lot of subscribers and they cannot stomach those 100% losses. So if you go at the money or in the money, there's less odds of a complete what we call crap out. But once we get to that point of this is a tradable opportunity, we identify what the target is, how far can this stock go, and based on the premium we have to buy the option for, if that option cannot achieve at least a 100% profit, we won't do the trade.
Yeah, certainly expiration, as you said, very important on how to do that, strike selection. And it was interesting to hear one of your factors there is certainly managing your account position and taking those huge losses. Crapping out is normally not something anybody wants to do, no matter what topic of discussion you're on. So it's interesting
right.
to hear how that all comes together.
Oh, it certainly is. And, what I say in my presentations when I'm traveling around the country is just ensure that you align, with respect to expiration, align your indicators to the time frame you're playing. If I'm liking a stock's prospects because of upgrades or downgrade potential, I cannot really expect that all these upgrades or downgrades are going to happen within a week period. So that's going to cause me to go out in time. But if I'm using options as a factor and I'm using as one of my indicators or tools, and I know there's a lot of put open interest that's going to expire and that's going to create some short covering, that's my edge. And here at Schaeffer's, we have to know at least one or two things about this stock that we think most people don't know about that stock. That's what we call our edge. And yes, if we are playing an option that has a good chance of crapping out, now we're up in our target potential to 200-300%, because we know we have to have a high average win to average loss to be successful.
Yeah, changing the leverage there a little bit. Let's just move into exiting techniques. The last thing One of the frequent questions that comes across my desk here is when investors say, well, how do I know when to get out of these trades, whether it's in my favor or not? And it's something that probably is unique to each investor. Some people have rules, some people don't. Some people treat it on a case-by-case basis. What can you tell us? A few things about getting out of the trade, whether it's in your favor or not.
Mm-hmm. Well, again, I think that all comes back, Ed, to knowing what your win rate's going to be. And that's one advantage I think we give people that subscribe to us. We are realistic that, okay, here up front, our win rate, depending on the option buying strategy you're utilizing, whether it's in the money options, at the money, or long, or maybe 4 to 6 month options, it's going to be falling between 35 to 45%. So now that we know that in order to be bottom line successful, we have to have a high average win, the high average loss. And now we also know that when you're buying option premium, with some strategies especially, you can lose 100% of what you put in. So we are always targeting at least 100% on each and every trade we do. Now, one extra strategy we do have on the profitable trades is once something gets to 100%, this isn't a rule, it's a guideline, we might tell our subscribers to take half the position off. Now we're taking a decent profit, but we're also taking advantage of the fact that you can make a multiple of what you put into the trade. So that trade could go on the second half to a 200-300% profit, which would net out to a 150-200% profit. So that's one way to get your average win up. On the loss side, some of that's dictated by how you enter the trade. If you're entering close to support and a support level breaks down, you can get out and keep the loss minimal. But as a guideline, again, I emphasize that word guideline. Once we're down about 50%, let's say 40, 50%, we're now making decisions. Okay, should we go ahead and exit or not? Now, if you're buying an at the money, and so a lot of times that might be driven by are your technical drivers broken down. Now, if you're buying an at the money option, you're playing a different animal than an in the money option. In the money options have high delta, and the time premium makes up less of the overall premium of the option. When you're buying an at the money option, most of the premium or all of the premium is time. So if you're buying all time premium, sometimes it makes sense then to use a time stop. So that might be the half-life. If you're buying today is October 9th, I think. Let's just say expiration's October 21st. I forget the exact expiration date. You might say, okay, in 6 trading days, if this thing isn't profitable, I'm going to close it. And that way you're not taking on all the time decay at that point. But when you're buying an at-the-money option, you've got to be pretty darn sure it's going to not only move, but it's going to move quickly and aggressively in your direction. And if that's not happening midway through the life of that trade, it's probably a good time to assess getting out. Because, again, you want that high average win, and you also want a low average loss because your win rate's going to be less than 50%.
Well, that was a lot of really good stuff there. Having targets helps. You mentioned having those targets basically being P&L or on time, and having the targets on both the upside and downside. Also scaling out. It's so simple. It's so easy to understand. And oftentimes when that comes up in conversation, investors need to be reminded scaling out of positions is a nice way to take some profits off the table when you have them, keep positions open, and keep them running. So that was a really great description. Thank you very much for that, Todd. Lastly, do you have any
call that
comments?
A free trade.
A free trade,
yeah, we call it a free trade when we take half because now you're guaranteed in a worst case scenario a break even. So you're playing with house money and your leverage. So that's
right.
And sometimes we'll take half positions out at 150%, and now we're guaranteeing the subscribers a profit no matter what happens.
Right. Yeah, it's a great way to manage out of positions when they're going your way. So the last thing, Todd, do you have any final comments or thoughts about the industry, about what you're doing over there at Schaeffer's? Any kind of words of wisdom for our listeners?
Sure. I think, and Ed, I've been saying this in recent months especially, options are a great risk management tool. I love buying options. I know a lot of people are afraid of them because of the time decay, but if you think, you can define how you use them. You can trade in the money options versus at the money options and use it as a stock substitute. So because options give you leverage, you can put much less money at risk, and you can control 100 shares of the stock because each option, one contract represents 100 shares of stock. So what some people will do is, hey, I'm getting sick of this headline risk every day. I don't want this headline risk. I do want to be involved. So they may sell their stocks and use options as a stock substitute. Now they can put much less money at risk, and they can do that and have the same profit opportunity because, remember, options give you leverage that equities don't. So you can put a lot less money at risk in the market, but also have the same profit opportunity. And no matter what these headlines, and no matter how they get resolved, you have profit potential. And, remember, you can make money in up and down markets. Some people will say, well, yeah, I can short a stock. But when you buy a put option, your risk is defined. When you short a stock, your risk is theoretically unlimited. So I think I can't remember a better time in my 25-plus years of doing this, given all the headline risk out there, whether it's domestically or overseas. I can't think of a better time to trade options, especially as a stock substitute.
I certainly could not agree more with all of that, and this really was a fantastic discussion. So, Todd, I want to thank you again for coming on the show. It was a great description of looking at the markets, taking long strategies, how to put them on, what the risk profile looks like, and some really good discussion on how to exit the position. So thank you very much, Todd, from Schaeffer's Investment Research, and that was today's Strategy Spotlight.
It's time for a nostalgia break. It's time to take a look back.
Sometimes it's fun to look back on a disaster that occurred, and that's what I want to do today in our Looking Back segment, specifically looking back at the collapse of Barings Bank. Barings was founded in 1762, based in London, and was one of the most well-respected institutions in the world for centuries. The Queen of England held money at Barings Bank. After 233 years in existence, the bank collapsed in 1995. So what happened? Literally one guy, one person who was trading derivatives in Asia brought the whole house down. Nick Leeson was hired by Barings in the early 1990s. Eventually, he basically became a one-man operation trading futures and options in Singapore with both trading and back office privileges. Obviously, this amount of authority and lack of oversight would not happen today. The downfall centered around an error account, which was very common back then because trading activity occurred through open outcry in the trading pits. When I was on the trading floor earlier in my career, we called these out trades, and we'd settle them the next day. These were potentially errors or discrepancies between the other side of a trade. Maybe the volume or the expiration date or the price may not match up with the other side, and you had to sort out those details. It was part of my daily routine to check what the out trades were from the previous day and then sort those out and straighten them out. If there was a large trade that occurred during the day, then we would double and triple check those on the top day. But this was just a common occurrence. Nick had an account at Barings where he placed these trades, which were executed in error, didn't match up, with the idea that they'd be settled or closed as soon as possible. He called this the 5/8 account, or numbered it literally 5/8, 88888, with 8 being considered a lucky number in the Chinese culture. That's why he picked it. But instead of closing these trades and taking the losses associated with them, Nick was a little more arrogant than that, and he let the positions ride, which were completely unauthorized, and he played market direction before closing them out. He did all of this just to avoid having to report losses. Now, unfortunately for him, this approach actually worked in the beginning. He was able to post huge profits and get compensated very well for that. In fact, in one instance, he recovered what otherwise would have been a £6 million loss when the market turned in his favor. But this was pure luck. And I say this was unfortunate for him that it worked out, because instead of recognizing how dangerous this approach was and how lucky he was to get out of the position, Nick became overconfident and immediately tried to do the same thing again, but this time with disastrous results. The next bad position placed on the error count kept getting worse. Nick doubled up again, and kept increasing the size, digging a deeper hole on another effectively unauthorized position. After an earthquake hit in Asia that sent the markets reeling, it was all over. And this position had lost an estimated 860 million pounds. There's one person responsible for that loss. That exceeded the entire value of Barings Bank. The bank went into bankruptcy. Nick Leeson went on the run and into hiding. Eventually he was caught and sentenced to 6 years in prison. He wrote a book after that called Rogue Trader about this entire experience that was also made into a movie by the same name starring Ewan McGregor. It's an excellent movie. If you like watching movies about trading in the financial markets, it's very entertaining, and I would highly recommend it. Again, called Rogue Trader. It was released in 1999. There's clear and obvious lessons to be learned here. Lessons stemming from risk management, trading discipline, and certainly humility and the psychology of trading. All of those things above are important for an investor to be successful. So throughout this, not having the oversight, having too much authority, not having the discipline that a good trader likely has resulted in a huge collapse of a bank that was over a couple of centuries old. And that's today's Looking Back.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
On a daily basis, it is always interesting to see where the most options are being traded each and every day and updated throughout the day. The Options Industry Council provides a list of the top 20 symbols listed top to bottom according to how much volume has traded on the day. This is called today's most active options and can be found at the top of the OIC homepage or within Section 10 of the site menu. The familiar names and most widely recognized ticker symbols will appear on a regular basis, but you will regularly find more obscure symbols that make their way onto the list. It's always interesting to see when these appear, and then you can check the headlines to investigate what news came out that's driving this amount of options activity. In addition to the total number of contracts traded on the day, the columns break down calls versus puts and calculate how much volume has been traded on the top day versus the symbol's average daily volume. You can also sort by equity, ETF, and index options, and that's today's most active options at the OIC website. A good resource that I often use myself is the Options Guide, www.optionsguide.com. The site is focused entirely on education. You can find a lot on options basics, which in addition to stock options also includes information on binary and futures options. But the most robust area of the site is its strategies section. There's about a dozen categories to choose from when you're looking for strategies: bullish, bearish, buying, selling, and a number of others. Also, there's a filtering tool which you can use that has inputs including market outlook, profit loss potential, and credit versus debit. Once you've selected a strategy, you'll be able to view a full-page, thorough description, including P&L graph, risk profile, break-even calculations, examples, and other similar strategies that you might want to view. That's the Options Guide. For a good read, I chose A Random Walk Down Wall Street by Burton Malkiel, that's M-A-L-K-I-E-L. It's originally published in 1973, highlighting the random walk hypothesis, which is not controversial, but not too well accepted, but it's certainly a good book regardless. This is a rather simple hypothesis which states that stock price movements are completely random, and investors will find it difficult to consistently outperform market averages. This might sound familiar to those of you familiar with the efficient market hypothesis, which assumes that all available information is reflected in the current market price, again posing a challenge to investors, as the theory assumes that future stock price movements will only be the result of information which is not yet known. An interesting test that the author conducted to try and prove his hypothesis, or at least add some credibility to it, was the coin toss test. Here he created a fictitious stock at a random starting price, and he'd flip a coin. If it turned out heads, he moved the stock price up 1%, and if it turned out tails, he'd move it down 1%, continue to flip the coin, continue to plot the points, and connect the dots. He would then turn over these graphs to technical analysts who sometimes would come back saying that they've analyzed the chart, and this particular stock is a screaming buy or a screaming sell. And Burton, of course, would come back and say, this is just derived from me flipping a coin, so it doesn't make much sense that you can have any type of analysis from it. So it's an interesting test to read about. Of course, there are many people who don't subscribe to this theory, Warren Buffett being amongst them, and many of you as well. Regardless of that, it's still an interesting read to hear the logic behind the theory, and especially if you're an investor who sometimes gets overconfident in your ability to pick stock direction, some of these ideas might provide you with a beneficial level of humility, which is something we can all use from time to time. That's a random walk down Wall Street by Burton Malkiel.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In our Industry Happenings segment, we've got your questions yet again. Got 3 of them today. First one from Barrett. Do you guys have a rule of thumb to keep from overpaying for an option? It's a great question, Barrett. Certainly we don't have a rule of thumb. Let me just provide some clarity on the price of an option. When someone tries to determine that an option is overpriced or expensive, they're usually talking about the volatility level. And the analysis that is generally done is to look at the current level of implied volatility and compare that to past levels of implied volatility and see where it falls. If it's higher today than it has been in the past, then maybe that option could be considered expensive, and if it's lower, then it could be in the category of being cheap. However, you always have to do a little further analysis. There may be very good reasons why current levels of implied volatility are higher or lower than their long-term average. So doing some analysis and a little bit more due diligence is usually required to have an opinion on whether or not current levels of implied are justified or if current levels will gravitate to their long-term average. That can help you make a decision. So each case will be a little bit different. Sometimes investors will decide that implied volatility levels that are out of line is justified and there's no trade to be made. And, of course, other times they'll make another decision. I hope that helps. Second question from PLC4. Is there a such thing as too much hedging? Well, I'm not going to be too direct with this answer, but I will approach this from the concept of deltas. When you're hedging, what you're doing is implementing a position that has the opposite delta exposure as your main position. Think about being long stock, which is long delta, and then buying a put option, which is short delta. That's what a hedge is. You have the deltas in the opposite directions. If you're looking at your overall position, you can simply just add them up. Stock is 100 deltas. It always is. If you buy a 30 delta put, you're net long 70 deltas. So now you can start to determine whether or not you have too much of a hedge. If you buy a 50 or a 60 delta put, is that too many short deltas? Or if you buy 3 of the 30 delta puts, that's actually 90 deltas you're getting on the short side. Is that too much? And you can decide for yourself whether or not you're paying too much for a hedge. Also keeping in mind, the more hedge you initiate, the less participation you'll have if the market moves in your direction. So I hope that helps with the answer about hedging. And the last question from Colin, what do you do when your long calls make money quicker than you originally anticipated? Well, this is a tough one. You can't certainly answer this question as a blanket way to manage your position in every circumstance. This will be looked at on a case-by-case basis. Just keep in mind, you're managing your position against your market outlook, and you're also managing your account. So you have 2 things you want to make sure are happening. One of them is that your position is still consistent with your market outlook, and be honest with yourself about that. You want to make sure that you're not hoping the market moves your way, that you truly feel, in this case with the long call, that you're bullish and that your long call is consistent with that. But also, as you're managing money, sometimes it's in your best interest to take profits when you have them. Sometimes you need to do that. It's a tougher decision, of course, when you just have one call option, but if you have a number of them, scaling out is a possibility. Many investors will take that route. But just keep in mind you're doing those two things, managing your position against your market outlook, making sure there's consistency there, and then managing your account and managing your money appropriately. And that's today's industry happenings.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation. And follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.